If you are collecting Social Security right now, the government is taxing your benefit twice. Once at the federal level using a formula that was written in 1983 and has never once been adjusted for inflation. And in 8 states, a second time at the state level on top of that. In 1984, when Congress first started taxing Social Security, only about 8% of retirees were affected. That was the intent. The thresholds were designed to touch only the highest earners. Today, because those same thresholds have sat frozen for over 40 years while benefits have increased with inflation every single year, roughly half of all Social Security recipients in this country are now paying federal income tax on their benefits. Half. Not because Congress raised the tax, not because anything changed in the law, simply because the number that determines who pays was never moved and inflation quietly pushed tens of millions of retirees across a line that was never meant to reach them. And on top of that federal layer, 8 states have their own separate tax weighting. Today, I'm going to show you exactly how the federal calculation works, how much relief the new 2025 law just handed you, and then name every state that is still taxing your benefit at the state level with the exact income numbers you need for 2026. Stay until the end. The move I cover at the end is the one that protects people in all 50 states, and most retirees have never used it. If you are not subscribed yet, hit that button right now and turn on the bell. Tax rules that affect your Social Security change every single year, and nobody from the government calls to explain what changed for your specific check. That is what this channel is here for. Subscribe and let's get into it. Here is how the federal calculation works and why it is quietly hitting so many more people than it was ever designed to reach. The IRS does not use your regular income to decide whether your Social Security is taxable. It uses a separate number called provisional income. To calculate it, you take your adjusted gross income, add any tax-exempt interest you earned, and then add 50% of your total annual Social Security benefit. That combined number is what the IRS compares against the thresholds. If you are a single filer and your provisional income is below $25,000, none of your Social Security is taxable. Between $25,000 and $34,000, up to 50% of your benefit can be taxed. Above $34,000, up to 85% of your benefit can be taxed. For married couples filing jointly, the numbers are $32,000 for the lower threshold and $44,000 for the upper one. Now here is the part nobody told you. Those thresholds have not moved a single dollar since 1983 and 1993. Not one adjustment for inflation in 40 years. A retiree in 1984 needed $25,000 in provisional income to start owing tax on their benefit. A retiree today needs the exact same $25,000, but according to CPI data, $25,000 in 1983 had the purchasing power of roughly $80,000 today. If Congress had simply tied those thresholds to inflation the way they tied Social Security benefits themselves to inflation, the lower threshold would sit at about $80,000 right now, and the upper threshold would be around $110,000. Instead, they sit exactly where they were set over 4 decades ago, and Social Security's own annual cost of living adjustments push more retirees across those frozen lines every single year without Congress doing anything at all. That is not an accident. It was designed that way deliberately to quietly expand the tax base over time, without ever having to hold a vote to raise taxes. Now here is what changed this year, and it is significant. The One Big Beautiful Bill, signed into law on July 4, 2025, and effective for tax years 2025 through 2028, added a new $6,000 senior bonus deduction for every person 65 and older, on top of the existing standard deduction you already receive. A married couple where both spouses are 65 or older can claim $12,000 in additional deductions this year. The deduction reduces your adjusted gross income, which in turn reduces your provisional income, which in turn can move you below the thresholds that determine how much of your Social Security is taxable. One analysis showed that for most retirees collecting the average benefit with modest additional income, the combination of the existing standard deduction and this new $6,000 deduction wipes out the federal tax on Social Security entirely. About 88% of Social Security recipients are expected to see their federal tax on benefits effectively go to zero for these 4 years. The 12% who still owe federal tax are those with substantial pensions, investment income, or other sources that keep their provisional income well above the upper threshold even after the deduction. The deduction phases out beginning at $75,000 in modified AGI for single filers and $150,000 for joint filers. If you had taxes withheld from your Social Security in 2025 and you qualify for this deduction, you may be owed a refund when you file. You can also file a new Form W-4V with the Social Security Administration to adjust or stop the withholding going forward, so you're not giving the government an interest-free loan every year on tax you no longer owe. Now the state layer. And this is where your zip code either costs you money or it does not. 42 states and Washington, D.C. take $0 in state tax from your Social Security. Zero. Not because they are generous, but because their laws specifically exempt it. 9 states have no income tax at all, including Florida, Texas, Nevada, Tennessee, and Washington. The other 33 have income taxes, but chose to protect Social Security from them. And as of January 1st, 2026, West Virginia joined that group permanently. West Virginia passed a law 3 years ago to phase out its Social Security tax gradually, and the final year of that phase-out just completed. West Virginia retirees filing their return next year will owe their state nothing on their Social Security. That is a real change that took effect this year, and most West Virginia retirees collecting benefits right now have not been told. The 8 states still on the list for 2026 are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Every one of them uses income thresholds, age rules, or credits that protect a significant portion of their retirees. Being in one of these states does not automatically mean you are paying the tax. The question is whether your income sits above or below the line for your specific state. Montana is the harshest state on this list, and it is also the least discussed. Where every other state on this list offers a meaningful income-based exemption that protects most retirees, Montana does not. If you are 65 or older in Montana, the state allows you to subtract only $5,500 from your federal taxable income across all retirement sources combined. Then the state applies a 5.65% tax rate on income above roughly $47,500 for single filers. If you are collecting any Social Security benefit above the most modest amount and you have any other retirement income at all, a portion of your benefit is being taxed by Montana with very little protection. A repeal attempt, House Bill 148, failed in the 2025 legislative session. Montana retirees are still on the hook. Minnesota is the most expensive state on this list if your income is above the threshold, because Minnesota's top income tax rate reaches 9.85%, the fourth highest state income tax rate in the country. Here is how the exemption works for 2026. Single filers with adjusted gross income at or below $84,490 pay zero Minnesota state tax on their Social Security. Married couples filing jointly at or below $108,320 are also fully exempt. Above those lines, the exemption phases out by 10% for every $4,000 of income above the threshold. A couple at $120,000 in AGI loses 30% of the exemption. The higher the income above the threshold, the more of the benefit is exposed to a rate that can approach 10%. Vermont has the strictest income limits of any state on this list and surprises a lot of middle-income retirees who assume they are safely below the line. Single filers with AGI at or below $55,000 pay zero Vermont state tax on benefits. Joint filers at or below $70,000 also pay nothing. But those numbers are tight. A couple with a small pension, modest investment income, and 2 Social Security checks can cross $70,000 without realizing it. Above $64,999 for single filers or $79,999 for joint filers, the Vermont exemption is gone entirely and benefits become fully taxable. Last spring, a woman in Burlington named Patricia shared in a retirement community forum that her household had been paying Vermont state tax on Social Security for 2 years before a neighbor explained the $70,000 joint threshold. She reduced her IRA withdrawal by $9,000 that year, stayed under the limit, and eliminated the entire Vermont bill. She said the savings were roughly $800, and she has managed her withdrawal the same way every year since. Connecticut taxes Social Security on paper but has thresholds that protect most middle-income retirees. Single filers with AGI under $75,000 owe nothing to Connecticut on their benefits. Joint filers under $100,000 also pay zero. Above those thresholds, Connecticut caps the damage by limiting the state tax to no more than 25% of your benefits. Rhode Island ties its exemption to both income and age. You must have reached full retirement age, which is 67 for anyone born in 1960 or later, and your AGI must be at or below 107,000 as a single filer or 133,750 as a joint filer. If you have not reached full retirement age, even a modest income will result in a Rhode Island state bill on your benefits. New Mexico has the most generous income thresholds of any taxing state, and most of its retirees owe nothing. Single filers at or below 100,000 in AGI are fully exempt. Joint filers at or below 150,000 are also fully exempt. Colorado is the most misunderstood state on the list. Residents 65 and older can subtract the full federally taxable amount of their Social Security from their Colorado taxable income, which means most Colorado retirees over 65 pay zero state tax on their benefits despite technically living in a taxing state. Utah does not offer a traditional exemption, but instead provides a non-refundable credit that offsets the state tax for single filers with modified AGI below 54,000 and joint filers below 90,000. Above those thresholds, Utah's flat 4.5% rate applies with the credit phasing out gradually. Now here's the move that works for every viewer, regardless of which state you live in. The new $6,000 senior bonus deduction that became law last year does not just reduce your federal tax, it reduces your adjusted gross income, and your adjusted gross income is the number every state on this list uses to decide whether you hit their exemption threshold. If you live in Vermont and your household AGI was sitting at $76,000, a $6,000 senior deduction brings you to $70,000. Full Vermont exemption, no state tax on your Social Security this year. If you live in Minnesota and your single filer AGI was $88,000, the deduction drops you to $82,000, below the $84,490 threshold, full Minnesota exemption. This is not a workaround, this is the law working exactly the way it was written. And the second move is managing the timing of your IRA withdrawals. Every dollar you pull from a traditional IRA or 401k counts toward your AGI, and therefore toward your provisional income at the federal level, and toward your state exemption threshold at the same time. Retirees who have flexibility in when they draw from retirement accounts and who stay aware of the threshold numbers for their specific state have a real opportunity to stay under the line in years that matter and use larger withdrawals in years when other income is lower or when they are converting to a Roth. Here is the single most important thing to take from this video. The federal threshold that determines whether your Social Security is taxable was written in 1983. It has never moved. Inflation has moved. Your benefit has moved with it every January through cost of living adjustments. The threshold has not. That is why roughly half of all Social Security recipients now pay a tax that was originally designed for only the top 10% of earners. The 8 states on today's list add a second layer on top of that. Knowing where your income sits relative to the federal thresholds, knowing the specific exemption number for your state, and using the new $6,000 senior deduction to manage where your AGI lands are the 3 things that determine whether you pay these taxes or not. The government does not calculate this for you in your favor. The deduction sits in the law waiting to be claimed. The state threshold sits in the law waiting to be checked. None of it is automatic. Send this video to one person you know who is collecting Social Security right now in any state. In the 42 states that pay zero at the state level, the federal calculation and the new $6,000 deduction still apply directly to their check every month. In the 8 states on today's list, this video could be worth hundreds or even thousands of dollars per year. One share takes 10 seconds, and it could be the most financially useful thing anyone sends them this year. That is what this channel is here to do. I will see you in the next one.